Let's jump right in. Welcome to this explainer. Today, we're going to demystify the completely chaotic, incredibly complex world of finance. We're using Burton Malkiel's absolutely legendary book, A Random Walk Down Wall Street, as our guide to help you cut through all that noise and become a masterful, confident investor yourself.
Okay, let's dive into this masterpiece. Since it hit the shelves back in 1973, this classic guide has sold well over 1.5 million copies. And, Malkiel, who's a Princeton economist and a former Wall Street portfolio manager, he brings this incredibly rare blend of high-level academic theory and gritty, street-smart reality to the table. His analysis has literally transformed how both academics and everyday people like us view the stock market.
Section 1. The Wall Street Illusion. Beating the Market.
So, look, we've all wondered this, right? Do those highly paid Wall Street analysts, the portfolio managers in the fancy pinstripe suits, do they truly possess some sort of crystal ball for picking winning stocks? Do they actually know something we don't? I mean, we are culturally hardwired to believe that paying top dollar for expert financial advice is going to yield better returns.
Well, Malkiel drops this absolutely legendary, kind of hilarious claim here. He says, a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by the experts. He coined this to illustrate a really harsh reality. Professional managers fundamentally cannot beat a randomly selected portfolio over the long haul. It's a massive insult to Wall Street for sure, but he backs it up with hard evidence.
And the stark data really proves his point. To put this into perspective, if you took 10 grand and just parked it in a passive, completely unmanaged S&P 500 index fund back in 1969, it grew to exactly $1,092,489 by April 2018. But what about an investor who put that exact same 10 grand into an actively managed expert fund? Well, they would have ended up with roughly $817,000. So that means our metaphorical blindfolded monkey effectively beats the average highly trained expert by nearly $300,000. No way, right? But it's true.
Section 2. How are stocks valued? Pricing theories.
Now, to understand exactly why the pros fail to beat the market, we first need to look at how stocks are actually priced. Malkiel outlines two competing theories here. On the one side, we've got the firm foundation theory. This is basically the idea of calculating a stock's worth based on its actual intrinsic fundamentals, things like future earnings and dividends. On the flip side, there's the castle in the air theory. This one proposes that pricing is based entirely on the psychological mood of the investing crowd. It argues a security is really only worth what someone else is willing to pay for it, totally ignoring underlying fundamentals.
And when that castle in the air crowd psychology completely takes the wheel, well, it consistently leads to what Malkiel perfectly calls the madness of crowds. Just looking at history, we see these deeply irrational, catastrophic market bubbles where humans happily pay absurd prices for just about anything. We're talking tulip bulbs in the 17th century Netherlands, to internet tech stocks in the 2000s, right up to homes in the 2007 US housing crash. The crowd overreacts, they build these castles in the air, and eventually, that bubble violently bursts.
Section 3. What is a random walk? Market predictability.
So this brings us to the core scientific thesis here. A random walk simply means that short-term changes in stock prices are completely unpredictable based on past history. Think of it like this. Just like the next flip of a fair coin is always 50-50, even if you just magically flipped 5 heads in a row, tomorrow's stock price movement doesn't care at all about today's. This makes those complicated chart patterns and short-term earnings forecasts essentially useless.
Of course, market professionals generally try to outsmart this randomness using one of two methods. Technical analysis studies past price momentum in charts, while fundamental analysis dives deep into company economics, trying to find undervalued stocks. But here's the kicker. Malkiel's data shows that whether the pros use technical or fundamental analysis, neither method can consistently beat a simple buy and hold market average, especially once you factor in their hefty trading costs and taxes.
Which brings us to a truly massive concept, the efficient market hypothesis, or EMH. This basically states that because news travels literally instantly in today's digital world and financial markets correct so rapidly, all known information is already baked into a stock's current price. There are just no predictable, exploitable patterns left for the experts to uncover. When new information arrives, it's unpredictable, meaning the price changes that follow must also be totally unpredictable.
Section 4. Investing by your age. Life Cycle Guide. Okay, let's dive into what you should actually do with your own money. I absolutely love this Mark Twain quote because he perfectly hits the nail on the head regarding the danger of speculation. There are 2 times in a man's life when he should not speculate, when he can't afford it and when he can.
It's brilliant. You just cannot win by gambling your savings. And this leads us directly into Malkiel's highly practical strategy of life cycle investing.
The idea here is that your investment strategy absolutely has to be tailored to your personal risk capacity. Take a 34-year-old wage earner. They have a high-risk capacity because they can afford to use their future salary to ride out major market crashes over time. But compare that to someone like Mildred, a 68-year-old widow who relies on a stable income for her daily living expenses. She simply cannot afford to see her portfolio drop by 50% overnight.
So, for that younger 34-year-old investor, we're looking at a naturally aggressive portfolio. Notice the really heavy weighting here in common and international stocks. At this age, you have decades to maximize long-term growth and recover from those inevitable economic dips. So keeping bonds very low makes total sense. The younger you are, the more you can lean into the volatility of equities.
But conversely, as you approach retirement, say around 64 years old, and you have fewer years of paid labor ahead to fall back on, your portfolio must drastically shift to minimize risk. You'll see a heavy reliance on stable bonds and dividend-paying real estate, or REITs, to generate reliable income. Basically, the older you get, the more conservative your asset allocation should become.
Section 5. The Ultimate Wealth Strategy. Practical Advice. At the end of the day, building wealth really boils down to 4 unglamorous but incredibly effective steps. 1. Start a regular savings program early because, honestly, how much you save is the single biggest driver of your wealth. 2. Put your money in passive, broad index funds on autopilot. 3. Use dollar-cost averaging, which just means investing a set amount regularly, reducing your risk of buying at a market peak. And 4. Periodically rebalance your portfolio to maintain that age-appropriate risk level we just talked about.
But perhaps the single most vital rule comes from the legendary financier J.P. Morgan. When a friend asked him what to do because he was losing sleep over his stock holdings, Morgan simply replied, "Sell down to the sleeping point." It's such a great reminder that while high rewards do require taking some risks, you always have to balance eating well with sleeping well.
As we wrap up this explainer, I want to leave you with a real thought-provoker for tonight. When it comes to your own financial future and knowing about the inevitable, totally unpredictable crashes of the stock market, what is your true sleeping point? Are you actually invested in a way that lets you sleep peacefully? Thank you so much for taking a random walk down Wall Street with me today, and keep learning.